Hello there, we're live. Thank you so much for joining me. Hey, while you're watching this now live or in the replay, do me a favor, hit me with a thumbs up and in the comments, let me know how I'm sounding to you. I added a couple of features, or I should say equipment, to the live stream setup. Not so much for the live stream, but for the radio show that I have coming out starting January 23rd on Monday, 9 a.m. to 9:30. It's a live show, and I'm doing it every day. It's going to be great. And someone asked me, "What are you going to talk about every day?" I'm like, "There's always something to talk about. How could you not have something to talk about when we're in the real world and every day is a day when you can't make this stuff up? There's plenty to talk about. Believe me, I won't run out of things to talk about. So let me know how I sound to you. Give us a thumbs up. Plus, when you do that, it helps spread the word about the good work we're doing here, and everybody else in your contacts and social would see it. It'll help the YouTube algorithm push out the live stream. And if you are watching on YouTube, please subscribe. Got a thumbs up from Frank. Hey, Frank, thank you very much. So, Frank, I had uh, John Caracciola here, not related to our friend Brad Caracciola, who owns actually, he's the owner of the radio station that I'll be on. And very nice guy, very down to earth. He actually is the one who came in and set up my stuff. It's just like you wouldn't know he owns a station and he's a successful guy if you just saw him. But I like that kind of person. And very cool guy. Set everything up. What he did is he put a couple of splitters on my audio board on my Rodecaster Pro 2. And my concern was that it would affect the sound. He said it wouldn't, and he was right. But you know me, I've got to be concerned about stuff like that. And thank you very much for the like, Frank, too. A couple of things to talk about. I want to answer a couple of questions about Social Security, give you a quick update in the market. And we're going to roll the intro first, and I'm going to just get right into the market and what's going on, because you should know there's a really big number coming out Thursday. It's a huge number, and it's the big number before the Fed's next interest rate meeting, its next policy setting meeting. So here's the intro, and we're going to get right into it. So just stick around for like 15 seconds, and here we go. All right. Thank you very much for joining me. And a couple of quick things to get into. And Frank says, you look and sound great. Thank you very much, buddy. I really appreciate the feedback. Frank is always my go-to source for this stuff because he knows how to live stream. He knows how to create content. Thank you, buddy. So, okay. Thank you very, very much, Frank. And it means a lot to me. So what are we going to do? Oh, yeah. Let's talk about a couple of quick things with Social Security. This is not meant to be the in-depth and most informative thing about Social Security, but a couple of things you should know about the percentage increase that people are getting. Okay, so let me just switch screens here, pop myself up in the corner, get rid of the social media icons. Approaching age 62, what you need to know about Social Security is 8.7% cost of living adjustments and claiming benefits. A couple of things you should know. If you're married and your spouse, well, first of all, if you claim at Social Security as soon as you're eligible at 62, you're getting a substantially reduced benefit, lower than what you would normally be entitled to if you would wait till full retirement age. For anybody born 1950 and later, that is age 67. Okay, so if you claim early, not only do you get a lower benefit, but your wife gets a lower benefit if she's relying on your benefits. Especially if you predecease her, she'll get a much lower benefit. So there's a lot of reason to wait at least till the age of 67 to get your full benefit. You get something like a 40% higher monthly benefit. The cost of living adjustment, again, it's 8.7%. Some people mistakenly think they have to claim their Social Security now to get that, to earn that COLA, cost of living adjustment. That's not true. You're entitled to it, whether if you claim now or not. You're getting that increase. So don't think you have to claim now to get that money. It's not true. You don't have to do that. So these are just two things you should really know about. The latest you could claim for Social Security is when you're 70. If you wait beyond that, you actually get hit with penalties. It's not like the money accumulates and one day you could say, you know what, I just won all that money. I'm 80 and I'll just take 10 years worth of Social Security. No, you're not getting that. You're going to get hit with penalties. So you have to take it, or you're not going to get the amount. I don't know why anybody would do that unless they were just completely ignorant of how the rules work with Social Security. So you want to make sure you do that. The other thing is, when you take money out of an IRA when you retire, as you know, money coming out of your IRA is like taxable income. It's income, okay? It's not just like a capital gains distribution. It's actually considered income, okay? Yes, I realize after 59 and a half, if you take money out of your IRA, you don't have to pay. I'm talking traditional IRA. You don't have to pay the 10% penalty. But what a lot of people don't realize is when you're, let's say, in your 60s, you start taking money out of Social Security. Out of your traditional IRA. That raises your income, which then you get hit with something called IRMAA. The point is, you actually have to pay more for things like Medicare, okay, because your income went up. So anything that is income-based will cost you more. Now, some of you don't care, and I hope you are someone who doesn't care about this stuff because you have so much money. It's no big deal. But some of you do have to be careful in retirement. Even if you're a good saver and investor, you still have to be careful. It's just, you see what happened to inflation in the last year. Even if inflation goes down, we're not going backwards in price. It just means if inflation goes down, it just means prices stop going up from where they are today. It does not mean prices go back to where they were in 2019, right before the pandemic. All right. The prices that we've seen up to now are pretty sticky. It doesn't mean they're going to go backwards. So the key is, if you have the opportunity to move some or all of your traditional IRA money into a Roth conversion, a Roth IRA, you'll pay the tax hit now, but you won't pay the taxes while you're in retirement, which means it won't affect your Social Security and your Medicare. So that is something that really I suggest people take a look at. And I also suggest doing that kind of move while the stock market is still down about 20% from its all-time high, and with many stocks down way more than 20%, and a lot of sectors down way more than 20% from their high, from their all-time high. So what you should do is work with your financial advisor and your accountant and see if it makes sense for you to make these moves, because they could save you a lot of money 10, 15 years down the road. And, when you do a Roth conversion, I always say, if you can afford to pay the taxes, let's say you're going to convert $100,000 of your IRA to a Roth IRA, that's $100,000 in income. You could go into a higher tax bracket and you could pay maybe $30,000 or more in taxes. If you don't have the cash set aside to do it, then maybe consider moving $20,000 or $30,000 of your IRA. But do something if you can. Do not convert an IRA with the expectation that you'll pay the taxes directly out of the IRA, and then just have less money to roll into the Roth 401k. That's a different story. It's hard for me to come up with scenarios where that would make sense. I brainstormed with my friend, my partner, Bobby, and we came up with a couple of scenarios in which it would pay to lower your assets at the same time. And if you had enough time for that money to grow, it might be worth it. But generally, rule of thumb, it's not worth it. But that's why we need to speak on a one-on-one to decide if it's worth at all to consider for you, or just with your own financial advisor and accountant. Okay. So there you go. Let's take a look at how things did in the world of finance. Okay. The Dow is up 186. So yesterday, the Dow was up over 300 and gave it all up and was down over 100. So today was a nice little rebound. And with these ups and downs, we're trying to figure out if there's a trend that we could hold on to in the market. This has just been so back and forth, up and down in the market. We call this volatility. Uh, it's really hard to decipher if there's a trend. The market just seems to be endless or aimless. We had one good day last Friday, but it's not really, one day does not make a trend. I'd rather have 10 days of the Dow being up 70 points than one day the Dow being up 700 points. I want a durable lift in the market, not a one-day wonder that goes right back down. NASDAQ up 1%, up 106 points. S&P up 27 points. Not a bad day, up 0.7%, getting close to that 4,000 mark. If the S&P could get above 4,000, a lot of people consider that bullish, and a lot of people believe that would attract more money to the market. Now, investors are extraordinarily pessimistic. Every investor poll shows how pessimistic investors are. Retail investors, institutional investors, just a lot of pessimism, a lot of cash raised with investors from selling stocks. If we get to 4,000 in the S&P and people start to believe, wait a minute, we're actually in a real rally, they're going to start putting that money to work because they don't want to get left behind. And that puts even more upside into the market, which then attracts even more people from the sideline to get back into the market. And with so much pessimism, we could carry a rally for quite some time. When I say quite some time, it could be a week and a half to a month and a half, maybe. But that would be pretty good for, based on how the market's been lately. Gold up a little bit in the 1800s, not far from 2000. Oil, $74, kind of flattish, but oil in the 70s will take. That means about $3 a gallon for gas, depending on where you live in the country. By me, I see $2.95, $2.99, $3.10, $3.15. Those are the ranges I see by me in Long Island. Where are they by you? 10-year, 3.6%. I'll show you what's really significant, okay, with interest rates. And the VIX continues to go lower at 20. There's a certain calmness in stocks, I think. Okay. So let me show you what I mean by what I want to show you about the bonds, about the bond market. Okay. The 6-month yield, all right, is 4.87%. So we've got a 6-month T-bill that's pushing up to 5%. When was the last time you got something 5% on something super stable, as safe as you can get? Short-term T-bills are safe. They're guaranteed. They are considered the risk-free rate of return. So almost 5% on a 6-month, yet the 10-year is only 3.6. So 4.8 minus 3.6, it's 120 basis point spread between a 6-month T-bill and a 10-year Treasury bond. That is such a steeply inverted yield curve, and that is telling you, and I've said this recently, that's shouting recession. But what's happening is there's a chorus of believers of the soft landing scenario. So soft landing is the Fed raises rates, slows the economy, maybe puts the economy into a very mild recession, or we just have a general slowdown without going into a recession in the U.S. economy. The hard landing is we have a recession that sucks and everybody is obliterated. Portfolios do a lot worse. Tons of people lose their jobs, people lose their houses, people can't buy cars, and it just spreads throughout the economy and it hurts the entire global economy. A lot of people thinking soft landing, which is why the market stopped going down and has been holding up a little bit better recently. It's up a little bit on the year. We'll see, but both arguments are so compelling that investors are stuck. It's a tug of war between two equally strong people. So therefore, the flag in the middle of the rope never really moves because the opposing forces here are so even. Soft landing versus hard landing. And that's why the market is more or less stuck. CPI numbers come out Thursday, the Consumer Price Index. It's a big number. Now, every month, investors hold on to a couple of economic statistics for dear life. One of them is the non-farm payroll figures, which came out this past Friday, sending the Dow up almost 800 points. The next big one is the the inflation figures, which is on Thursday, released 8:30 a.m. The CPI, Consumer Price Index. And again, every month investors get all ginned up about it, and they say this is it. It's going to be lower than expected. The Fed's going to pause from raising interest rates, and the stock market's going to right back up, and we're going to be in good shape. It's very plausible that this could happen because inflation is trending down rather quickly. Rents, which is the biggest component of the CPI, are coming down. The price of used cars is coming down. Lots of things, a lot of food prices are coming down. You might not notice this yet, but prices are coming down. Certainly, you may have noticed that you should notice the price of gasoline is coming down. So the CPI figure is coming down, which could mean the Fed could claim victory against inflation and stop raising rates, or at least only raise rates very incrementally going forward, and maybe one or two more times and stop. The going bet is the Fed has a quarter-point hike in the tank at its next meeting in a couple of weeks. And maybe it'll either do one more quarter point or not a quarter point and just do nothing. But the half a point hike is pretty much out of consideration now. So that's one of the things that's keeping investors bulled up. And we'll have to see. But this is, we've all become data dependent. Now, as a stock picker, and I don't want you to think I only pick individual stocks. I use exchange traded funds. I have clients that strictly exchange traded funds. It's all dependent on what the client needs or what's appropriate for the client. Okay. Some people want individual stocks. Some people don't. To answer your question, if I find somebody who is inappropriate for individual stocks, but they want individual stocks, so I give them a portfolio of individual stocks? No. They're probably not really going to be a good client for me if I don't think they have the risk tolerance and wherewithal for individual stocks, just to get that out of the way. I don't think any financial advisor would do that. I know that sounds a little naive, but I know that in the world of Mitch, of the financial advisors I know, they wouldn't do that. The financial advisors I am tight with are really good people and good at their jobs. All right. So that is the story of what's going on with the market. The action is no action until we get the CPI figures on Thursday morning, at which point we expect a pretty big reaction one way or the other. So a lot of investors are hedging their bets using derivatives, right? They're using options to hedge their bets. That's fine. I don't recommend that for retail individual investors because it's a very expensive proposition, and over the long term, I don't think you need it. And I really want you to stop thinking in terms of, it's so bad if your portfolio goes down. If you were a fund manager or a hedge fund manager, I could see you being concerned about your portfolio going down. But I'm a retail investor. I'm just like you, okay? I expect my account will have variations, will go up and down. I'm not afraid of it. I'm like, I have to do something to make sure my account doesn't go down. I have seen more people lose money trying to keep their portfolio from going down than what they've lost from the stock market actually going down. And the fact is, the market recovers. Individual stocks don't always recover, which is a really good reason for people not to be in individual stocks. But the averages recover. The broad-based averages recover. The investments, the mutual funds or exchange-traded funds that follow broad-based investments and follow even index, or sector funds and general index funds, they recover. Now, you can't invest directly into an index, but again, you could invest into a security that tracks or mimics an index. So these are some of the things that we need to talk about more. There are a couple of trends that are developing for 2023. I've seen a lot of analysts putting out a lot of work into writing about electric vehicle infrastructure. That's expected to be a big area for investors. The other thing that's expected to be a big area for investors to take interest in, or investors expect to take an interest in, is industrials. Because even though, generally speaking, the consensus is the economy is going to get worse for the first half of the year, we're going to get worse progressively into the first half of this year, and then we're going to start to get better. The economy is going to get better in the second half. So why make any major moves or sell anything if I know things are going to get better? The other thing is stocks typically trade with 6 months lead. So if you believe the economy gets better in 6 months, you want to buy economically sensitive stocks now. What's economically sensitive? Industrial companies, companies that make machinery, for example. They are subject, or very sensitive, I should say, to the vagaries of the economy. The economy improves, companies start spending money on machinery. Farmers spend money on John Deere. You see construction go up, so Caterpillar makes more money. Construction materials, start to do better. We have a lot of good things to worry about. But the bottom line for you is I would not be making like major changes to your portfolio every time the general consensus believes we're going into a soft landing. Then the general consensus is we're going into a hard landing. Then the general consensus is everything's going to be rosy the second half of the year. I think what you need to really do is build a portfolio that's right for you and stick to the things that you can control. Right? You can control your dollar cost averaging every pay period with your 401k plan. You could rebalance your portfolio. You could maybe make sure parts of your life are properly insured so you don't have a substantial economic loss. You pay a little bit of an economic loss called insurance premiums to avoid a big economic loss instead, right, to avoid a big economic loss. These are the things that you could control. You might be looking to educate yourself. In other words, if you believe a recession is coming and you believe your job could be at stake, what are you doing to make yourself more valuable in the workplace? Are you taking advanced courses? Are you getting any new certificates? Are you going on LinkedIn and taking LinkedIn classes? These are really important. I'm an employer, and I want to see that people, potential employees, did something with their time while they were worried about the stock market or about the economy. Okay? Not someone who just didn't do anything. They waited to get laid off, and now they want a new job. So I'm just letting you know, as an employer, what I see. I need to see that kind of initiative. I need to see people investing their time and money into skills. Are you investing in skills? Are you doing anything to take new classes, learn a new skill, new certificates? Let me know in the comments. I would love to know about that. So I hope you guys all have a great rest of the day. I will be back tomorrow. Tomorrow is only Wednesday, but then we've got the figures coming, the CPI figures coming out Thursday. A lot of things to look forward to. By the end of the week, we're going to start to get fourth quarter earnings announcement from the fourth quarter of 2022. But with that comes CEO and CFO, management forecasts for the rest of the year. And we want to know what managers of corporations are saying about the year ahead. Do they agree with the general consensus of Wall Street? Do they not? And we need, because people want to start picking their positions for the year. I personally have positions picked for the year for me. They are oddly the same positions that I had for last year because the ones I'm holding are long-term. It's very common for me to have stocks with my clients that have been in my clients' portfolios for 15, 20 years or more. I'm a long-term holder. I'll give you an example. Okay, just want to say, it's like Boeing today got a downgrade. The analyst said the stock has gone up as much as it's going to go up for a long time. All the good news is factored in, and it's time to just let business percolate and fundamentals work their way through so we could eventually maybe see the stock go higher. To me, analysts' upgrades and downgrades come by pretty regularly, pretty often. And by the time you sell the stock, another analyst comes around and upgrades the stock, or the same analyst gets around to upgrading the stock, and they'll say, well, now we want to upgrade the stock to a buy from a sell or from a hold because things improved. And in the meantime, you would have been better off just holding on to the stock instead of trying to dart in and out and figure out what the exact right price is to get in and out. Ultimately, I've seen the same stock over a 20-year period receive so many buy recommendations and sell recommendations and hold recommendations over time. And over time, I'm just glad I ignored it and just held on to the stock. And that takes a lot of willpower. And that's why I like to pick the stocks I do. One of the things I look for in a stock is if it's a brand name. I'm not looking to be hero and find the no-name stock that no one ever heard of and say, this is a stock I have for you. I'm not looking for that. It's just not my thing. It could be your thing. But I'm not really looking for the emerging growth stocks because when you have a market like the we had now, these stocks could go down 80, 90%. And a lot of stocks went down that much or more, like Peloton, Roku, DoorDash got killed, Moderna got killed. All those hot stocks. Actually, Moderna recovered. I shouldn't throw them into there. But Airbnb, a lot of these hot stocks from the pandemic just got absolutely crushed. Coinbase is another one. Coinbase just announced that they're laying off about 20% of their workforce. It helped the stock go up because they need to stabilize fundamentals. Last thing I'll say is a lot of companies try to cut costs. The Amazons, Facebooks of the world, Googles of the world, the top big companies, this is the first time we're ever going through the culling of employees we've ever seen in these companies. These companies just had such rapid growth trajectories that they couldn't get enough employees. They couldn't spend enough money to maintain their growth and to keep up with demand for their digital products. But that's changed. And now these companies are real companies and they have to control and manage expenses, things like headcount, facilities management. They have to do all of these things. We've never seen this happen before, but they're real companies now. Tesla comes out with booming manufacturing and booming auto delivery numbers. Stock goes down. Why? Because now it's a real company. And if you value it like a real company, you compare it to companies like Toyota, you realize how overvalued it is now as a real company. Sometimes companies are best trading on the future dream than they are trading on the realized dream. It's crazy, I know, but that's just the way it is. Have a great day, everybody. See you tomorrow.